there was an emperor in 64 AD who figured out he could pay for his empire by putting less silver in the coins that everyone used for money. His name was Nero, and he convinced Rome that the new coins were worth the same as the old ones. Within 200 years, the Roman silver coin went from 95% pure silver to less than 5% silver, basically worthless copper, with a thin silver wash on the outside. Roman soldiers who were paid in these coins found their wages bought less and less each year. Roman citizens who saved their money watched their life savings quietly evaporate while they slept. The Roman economy eventually collapsed, and the empire fell apart. I'm telling you this because the same pattern is happening right now, except this time, it's not a Roman emperor debasing silver coins. It's central banks debasing your dollars. My name is Joe, and I spend way too much time thinking about how most people are sleepwalking into financial disasters they could easily avoid. If you're someone who feels like traditional money management advice sounds great in theory, but your savings never seem to keep up with the cost of living, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that the US government and Federal Reserve use to destroy your purchasing power without you noticing. Why everything you've been told about safe dollars is a lie. And what I'd actually do if I wanted to protect my wealth in 2026, knowing what I know now about how money really works, versus how it's sold to you. So let's go back to Rome in 64 AD. Here's what happened. Nero was facing a financial crisis. The Roman Empire was expensive to run, wars were draining the treasury, and Nero wanted to build his famous palace. So he came up with a solution. Instead of raising taxes or cutting spending, he would just put less silver in the coins. The denarius, which had been 95% silver for centuries, was reduced to about 93.5% silver. That doesn't sound like much, right? Just a 1.5% reduction. But here's the brilliant part of the scheme. The coins still looked the same. They weighed roughly the same. They had the same face value. People kept using them as if nothing had changed. The Roman government could now spend the same amount of coins, but use less actual silver, effectively creating money out of nothing. And it worked. At first, Rome could pay its soldiers and build its palaces without raising taxes. But here's the catch. Once you start debasing currency, it's very hard to stop. Every emperor after Nero faced the same temptation. Why fix the underlying problems when you can just keep making the coins worth less? By 200 AD, the denarius was down to about 50% silver. By 240 AD, it was at 40%. By 274 AD, under Emperor Aurelian, the denarius was less than 5% silver. That's a 95% reduction in silver content over 210 years. Now, you might be thinking, okay, but that was ancient Rome. We have modern central banks and sophisticated economic systems. We don't just put less metal in coins. That's true. We don't put less metal in coins. We do something much more sophisticated. We print money, but the psychology and the mechanism are exactly the same. Let me show you what I mean. Lie number one, the dollar is a store of value. This is the biggest lie of all. You hear it everywhere. Save your money. Build an emergency fund in cash. Keep 3 to 6 months of expenses in a savings account. But think about this. If the dollar loses 2 to 3% of its value every year on average, which is what the Federal Reserve actually targets, then keeping your savings in dollars isn't saving. If you have $50,000 in a savings account earning 1% interest while inflation is 3%, you're effectively losing 2% of your purchasing power every single year. After 10 years, your account still says $50,000, but it can only buy what $41,000 could buy when you started. You lost $9,000 of purchasing power and you didn't even know it was happening. When the US government spends more money than it collects in taxes, which is basically every year now, it has to borrow the difference. But here's the problem. The US national debt is now over $36 trillion. To put that in perspective, if you made $60,000 a year, but owed $72,000 on credit cards, your debt-to-income ratio would be the same as the United States government. And this debt is growing every year. At some point, there aren't enough private investors willing to buy all these treasuries at the interest rates the government wants to pay. So what happens when there aren't enough buyers for US debt? The Federal Reserve steps in and buys the treasuries itself. They literally create money out of thin air and use it to buy government debt. This is called quantitative easing, but what it really means is monetizing the debt. And this is where the debasement happens. When the Federal Reserve creates money to buy government debt, it increases the money supply without increasing the amount of goods and services in the economy. More money chasing the same stuff means higher prices. And who pays for this? Not the government. They get to spend the money. Not the banks, they make money on the transactions. The people who pay are savers and wage earners. People who hold dollars, people whose wages don't keep up with inflation. This is what economists call the inflation tax. And it's the most regressive tax there is because it hurts the poor and middle class the most. Here's who wins in this system. The government wins because they can spend money they don't have without raising taxes. They pay off old debts with new, cheaper dollars. Banks and financial institutions win because they get first access to the newly created money and can buy assets before prices rise. People who own productive assets like real estate, businesses, and stocks win because these assets typically go up in price when the money supply expands. And here's who loses. People who save in cash or bank accounts. People on fixed incomes. Wage earners whose salaries don't keep up with the real cost of living. Basically, anyone who follows conventional financial advice and keeps their money in dollars. Now, let me give you the emotional reframe you need. You are not a customer in the fiat system. You are the product. The government and financial industry make money from inflation and seigniorage, which is the profit from creating money, not from protecting your wealth. When they say save in dollars, what they mean is hold this depreciating asset so we can keep spending money we don't have. I'm not saying the dollar is evil or that the Federal Reserve is malicious. I'm saying blind trust in fiat currency in 2026 is playing a game where the rules are rigged against you. The system is designed to transfer wealth from savers to debtors, from the bottom to the top, from those who hold currency to those who create it. So if I were starting fresh right now, knowing what I know, here's exactly what I'd do to protect my wealth. Not what sounds good in theory, not what worked in 1980, but what actually makes sense given the current monetary environment and the reality of currency debasement. Action step 1, I'd understand what money actually is. Not what I think it is, what it actually is. Money has 3 properties. It's a medium of exchange, a unit of account, and a store of value. The dollar is great as a medium of exchange. It's easy to use, widely accepted, convenient for transactions. It's okay as a unit of account. Prices are quoted in dollars. We all understand what a dollar is worth relative to other things. That's not a store of value. That's a store of guaranteed losses. Once you understand this, you stop thinking about dollars in terms of the number and start thinking in terms of purchasing power. $100,000 in 1971 was a fortune. $100,000 today is barely enough to buy a modest home in many cities. The number is the same. The value is completely different. Action step 2. I'd implement what I call the hard money allocation strategy. Here's how it works. Instead of keeping all my wealth in dollars, which are guaranteed to lose purchasing power, I'd allocate a meaningful percentage of my net worth into things that cannot be debased. This includes gold, which has been money for 5,000 years and has preserved wealth through every monetary collapse in history. Real estate, which is real property that generates income and typically rises with inflation. Productive assets like stocks of companies that make real things and generate real cash flow, not speculative growth stocks. And yes, a small position in Bitcoin, which is digital gold with a fixed supply of 21 million coins that can never be increased. I'm not saying sell everything and go all in on hard money. I'm saying if 100% of your wealth is in dollars, you're guaranteed to lose purchasing power. If you have a mix of dollars and hard assets, you're protected from different outcomes. Here's the math on why this matters. Let's say you have $200,000 in a savings account, earning 1% interest, while inflation is 3%. After 10 years, you'll have about $221,000 in the account. But because of inflation, that $221,000 will only have the purchasing power of about $164,000 in today's terms. You effectively lost $36,000 of purchasing power. Now, imagine you had allocated 20% of your wealth to hard assets instead. $160,000 in cash, $40,000 in gold, real estate, and Bitcoin. If inflation averages 3% per year, your cash still loses purchasing power, but your hard assets typically rise with inflation, so their purchasing power stays roughly the same or even increases. After 10 years, your total portfolio might be worth more in nominal terms, but more importantly, your purchasing power is preserved instead of destroyed. That's the difference between slowly going broke and preserving wealth. But now you might be thinking, what if the dollar gets stronger? What if deflation happens and cash becomes more valuable? Here's the thing. You have to decide what you're optimizing for. Are you trying to maximize your upside if the current monetary system keeps working perfectly? Or are you trying to build actual wealth that survives different monetary conditions? Because nobody, and I mean nobody, can tell you what the dollar will be worth in 10 years. The dollar looked stable in 1960. It looked stable in 1970. Then, Nixon closed the gold window in 1971, and everything changed. The dollar could get stronger, it could get weaker, it could collapse entirely. I'd rather have a mix of assets that protects me from different scenarios than bet everything on one outcome. These are rules that force me to maintain my target allocation without having to rely on willpower or timing the market. Here's an example rule. If the money supply grows more than 10% in a year, I automatically increase my hard money allocation by 2%. These aren't market timing. These are discipline. You're not trying to predict the future. You're adapting to what's actually happening in the monetary system. I'd build an income floor outside the dollar system. This is psychological as much as financial. The reason people panic during inflation or currency crises is because they need the money and their income is denominated in depreciating currency. If you have income streams that are not tied to the dollar, you can survive monetary instability without panic. This could be rental income from real estate, which typically rises with inflation, dividends from productive companies that can raise prices, side business income that's based on skills, not currency, even a small allocation to Bitcoin, which could become a monetary alternative. The goal is that if the dollar loses 50% of its purchasing power over the next decade, your life doesn't fall apart because your income and assets adjust with it. Here's the math. If you spend $60,000 a year and all your income is in dollars and inflation averages 5% per year, you need to earn $66,000 next year just to maintain your lifestyle. $69,000 the year after. $73,000 the year after that. You're on a treadmill that keeps getting faster. But if you have $30,000 of income from assets that rise with inflation, you only need $36,000 from dollar-based income. You're half as exposed to the treadmill. And if the dollar really crashes, your hard assets might actually increase in purchasing power, while your dollar income becomes worthless. Same event, opposite outcomes, entirely based on how you structured your income and assets. Action step 5. I'd get really honest about time horizon. The advice to keep your emergency fund in cash is great if you need the money in 6 months. But if you're saving for 10, 20, 30 years from now, why would you keep that money in an asset that's guaranteed to lose purchasing power? Most people have their entire net worth in dollars or dollar-denominated assets. Their house, their 401k, their savings account, everything is tied to the dollar. They have zero hedge against the very currency they're using. That's not diversification, that's concentration risk. And it's the opposite of what wealthy people do. Wealthy families have multiple currencies, multiple assets, multiple income streams. They're not dependent on any one monetary system. Neither should you be. So here's the bigger picture. Why? Because it's profitable for them and easy to scale. They make money on fees and volume, not from your returns. When you buy mutual funds, they collect management fees regardless of whether you make money. When you buy treasury bonds, you're effectively lending money to the government at rates that are often lower than inflation. They're not wrong that dollars are useful for transactions, but they're lying by omission when they act like dollars are a good store of value. Just like Nero convinced Rome that debased coins were worth the same as pure silver coins, the financial industry has convinced you that dollars that lose 3% of their value every year are the same as real money. They're not. Dollars are a debt instrument that loses value every year. Hard assets like gold, real estate, and productive businesses cannot be debased. And at a certain point in your wealth building journey, you need to stop playing the game that's rigged against you and start playing the game that actually preserves wealth. Now, am I saying the dollar is going to collapse tomorrow? No, I have no idea, and neither does anyone else. The dollar might remain the world reserve currency for another 50 years. What I'm saying is that if you're not aware of how the system works, if you're not protecting yourself from currency debasement, you're making the same mistake that Roman citizens made 2,000 years ago. You're assuming that what worked recently will work forever, and you're ignoring the structure of the monetary system you're actually using. Let me tell you what the smart money is doing. And by smart money, I don't mean crypto influencers. I mean hedge fund managers like Ray Dalio, who manages over $150 billion. He's been warning about currency debasement for years and recommends holding gold and other hard assets. I mean family offices that manage wealth for ultra high net worth families. They typically have less than 20% of their wealth in cash and the rest in real assets. I mean central banks, which have been buying more gold in recent years than at any time since the 1960s. But you can replicate the philosophy. Own some hard money that cannot be debased. Don't let your entire net worth be in a depreciating currency. Build income streams that aren't entirely dependent on dollars. Boring, I know, but boring is what survives. Here's what I'd avoid in 2026. I'd avoid anything that's sold as guaranteed returns in dollars. If it returns 5% in dollars, but inflation is 7%, you're losing 2% of purchasing power. That's not a guaranteed return. That's a guaranteed loss. I'd avoid trying to time the market by going to cash and waiting for a collapse, because you'll miss years of returns and probably get back in at the wrong time anyway. And I'd avoid the temptation to do nothing just because doing something feels overwhelming. Doing nothing right now when the money supply is expanding at historic rates is an active choice to lose purchasing power. It's not neutral. You're not being conservative. You're being passive, and there's a difference. Let's talk about the psychological shift that needs to happen. Most people treat their savings like a piggy bank. Put dollars in, take dollars out. The number goes up or down, but it's all dollars. That worked great when dollars were actually backed by gold and couldn't be debased. But we haven't been on the gold standard since 1971. We've been on a fiat standard for over 50 years. And in a fiat system, holding all your wealth in the currency is a guaranteed way to lose purchasing power over time. You have to start thinking in terms of purchasing power, not dollar amounts. When you look at your bank account, you shouldn't see $50,000. You should see what that 50K can actually buy. And you should understand that what it can buy will be less next year and less the year after, unless you do something about it. The reason this matters emotionally is that when the next monetary crisis comes, and it will come because every fiat currency in history has eventually been debased, you need to know that you protected yourself. If you just kept everything in dollars and hoped you're going to feel like a victim when your savings evaporate, you'll panic. You'll make bad decisions. But if you've already taken steps to diversify into hard assets, to build non-dollar income, to think in terms of purchasing power, you'll feel like you prepared. You won't be happy about what's happening to the currency, but you won't be destroyed. You'll be able to maintain your lifestyle while others are struggling. And that's the difference between people who preserve wealth through monetary transitions and people who get wrecked. Here's a scenario to make it concrete. It's 2028. The US debt crisis has reached a breaking point. The government can't find enough buyers for treasuries at reasonable interest rates. The Federal Reserve has to step in and buy massive amounts of debt, effectively printing trillions of new dollars. Inflation spikes to 8% per year and stays there for several years. The dollar loses 30% of its purchasing power over 3 years. Your coworker, who has everything in dollar savings accounts and bonds, sees his net worth drop by 30% in real terms. He's angry, he's scared, he can't afford the same lifestyle he had 3 years ago. He has to cut back on everything. You, on the other hand, allocated 30% of your wealth to hard assets 5 years ago. Your gold, real estate, and Bitcoin have all gone up in dollar terms because they're hedges against inflation. Your total net worth might be the same in dollar terms, but your purchasing power is preserved because your hard assets adjusted to the new reality. Same monetary event, different outcome because you prepared. That's what I mean by taking control. You can't control what the government does with the money supply, but you can control your allocation, your assets, your monetary resilience. Most people give up all three because they're told that saving in dollars is the only normal option. Let me give you one more historical example to drive this home. In 1914, before World War I, the German mark was a strong currency backed by gold. By 1923, after years of war debt reparations and money printing, the mark had collapsed so completely that people were using wheelbarrows full of cash to buy bread. People who had their life savings in marks lost everything. Pension funds were wiped out. The entire middle class was destroyed. But the people who had gold or foreign currency or real assets preserved their wealth. They could still buy food, they could still pay rent, they survived. Now, Germany had specific problems, and the US is not Germany. But the point is that currency collapses happen. And when they do, the people who hold the failing currency get destroyed. The people who hold hard money survive. So the lesson is not don't use dollars for transactions. The dollar is still useful for buying things today. The lesson is don't assume that dollars will be a good store of value forever. The dollar has lost 87% of its value since 1971. That's not a crisis. That's slow, invisible destruction of wealth that's been happening for 50 years. What would I actually do in 2026 if I were building a portfolio from scratch? Here's the allocation I'd start with. And I want to be clear, this is not financial advice. This is what I do for myself, knowing my risk tolerance and understanding of monetary systems. 30% in productive assets. Stocks of companies that make real things, generate real cash flow, and have pricing power, not speculative growth stocks. Real businesses that can raise prices when inflation hits. 20% in real assets. This could be your own home if you own it, rental real estate, or REITs that own physical property. Real estate is a natural hedge against inflation because property values and rents typically rise with the money supply. 20% in gold. Physical gold you hold yourself or allocated gold accounts. Not gold ETFs or paper gold. Real gold that cannot be debased or diluted. 10% in Bitcoin. Not because I think it's going to the moon, but because it's digital gold with a fixed supply and cannot be debased. 10% in cash or short-term equivalents. You still need liquidity for emergencies and opportunities. 10% in skills and education. The value of what you can do doesn't depend on the monetary system. That's 100%. And notice that only 10% is in cash. Everything else is in assets that cannot be debased or that naturally adjust to inflation. This mix gives you exposure to productive assets for growth, real assets for inflation protection, gold for wealth preservation, Bitcoin for asymmetric upside, cash for liquidity, and skills for resilience. No single point of failure. If the dollar stays strong, you still have productive assets and real estate. If inflation spikes, your hard assets protect you. If the monetary system collapses, your hard money preserves your wealth. You're not trying to predict the future. You're trying to survive different versions of it. Would this allocation beat an all-dollar portfolio if the dollar stays strong and inflation stays low? No, it wouldn't. You'd underperform a bit because gold and Bitcoin are volatile and don't always go up. And that's okay. Because if the dollar collapses or inflation spikes or the monetary system transitions, you'd outperform by a huge margin. You're trading maximum potential upside in a best-case scenario for protection against catastrophic loss in a worst-case scenario. And at a certain point in your wealth-building journey, that's the right trade. When you're trying to get your first $100,000, sure, take more risk and optimize for growth. When you're trying to protect $500,000 or $1 million, not losing it becomes more important than doubling it. Here's the final psychological shift. Wealth is not built by hitting home runs with speculative investments. It's built by not losing purchasing power to currency debasement. If you can preserve your purchasing power through monetary transitions and avoid catastrophic losses, you'll end up in the top 10% of savers over 30 years. The people who chase 20% annual returns in the stock market are the same people who get wrecked when the market crashes or the currency collapses. Slow and steady preservation of purchasing power actually wins, but only if you're steady through the volatility. And you can only be steady if you understand what you own and why. That's it. Not complicated, not sexy, not gonna make me rich overnight, but it's real. It's based on how money actually works and how monetary systems actually fail. And it's designed to survive different monetary outcomes instead of relying on the current system to keep working forever. Most people won't do this because it requires effort, and it means admitting that the default option might not be the best option. But if you're still watching, you're not most people. You're someone who actually wants to understand this stuff and make smart decisions, not just follow the crowd off a cliff. So go look at the M2 money supply chart tonight. Look at how much it's grown since 2008. Look at how much the dollar has lost in purchasing power since 1971. Then ask yourself if keeping 100% of your wealth in dollars is really the smart move. The Romans didn't notice their coins were being debased until it was too late. Don't make the same mistake.